Hello, everyone. This is Tim McCusker, Chief Investment Officer for NEPC. Thank you for joining us today. We're excited to share our latest market outlook. I'm excited to be joined today by Phil Nelson, our Director of Asset Allocation, and Sarah Samuels, our Director of Marketable Securities. I'll take you through a very brief NEPC update. I'll go through looking back at the second quarter and then talk about our key themes. Phil will talk to you about our strategic outlook, including our latest assumptions that we finalized as of June 30, 2020. As we've talked about, we moved to a quarterly approach for assumptions, but you'll notice that's under the strategic outlook because we want to make sure that even though we're using the latest market data each quarter to forecast, we don't want these to be used in an overly tactical way. They're meant for 10-year time horizons. They're meant for that strategic view. Sarah will go take a deeper dive into each of the beta groups and talk about some of our thoughts within asset classes. And then we'll leave some time at the end for your questions. You'll notice that chat function in your GoToWebinar panel. Feel free to shoot a question in and we'll do our best to get to as many as we can. So from an NEPC perspective, we're continuing to operate effectively. It's been certainly unique times, as I know it is for so many of you. Most of us continue to work remotely, but we have opened up our offices on a voluntary basis, and some of us have gone in, and it's been great to see people, even though it's a small number. For those that feel like it's safe for them to do so, whether it's a change of scenery or just a better work environment, we're giving them the option to come into the office, even if it's just for a few days a week. Our focus remains on helping clients, and I just want to make sure that everyone knows, as I hope you do already, that you have the full breadth of NEPC resources available to you, whether it's through your lead consultant or directly to one of our professionals. Know that you've got access to our entire research team and to our senior leadership group if there's any way that we can be helpful. We're really excited about all of the content and insights that we've produced over the last few months, and if you're not doing so already, whether getting the reminders in our weekly email or just going there directly, head to our Insights tab on our website. We've got the link here, and the slides will be available afterwards. And check out the great content that's out there, whether it's recordings of the CIO Conversation Series, which I know I had a lot of fun doing the last few months, talking to some of the brightest minds in our industry and getting their thoughts. We've got a blog series on value versus growth and how we think you should be positioning there, and lots of other content, blogs, papers, hopefully some things that resonate for some of the elements that you may be working through in your portfolios. And then from a business perspective, we remain stable and strong. I think we're in a really strong position, and we look at this as a time for NEPC to really shine. In these uncertain and unprecedented times, with markets doing things that you'd never expect relative to the economic results, we think this is a time for us to really put our best foot forward for clients. With the changes in markets, objectives may have changed, risk tolerance may have changed, organizational objectives may have changed, and if there's ways that we can be helpful, we want to make sure that we're being the best partner that we can be and a trusted advisor to all of our clients. So let me turn to markets. Amazing to have a conversation about Q2 and think about how recently we're having that conversation about Q1 with markets down 20%. We're now talking about risky asset markets in tremendous recovery, equity markets up over 20%, credit markets performing quite well, bringing back most of the losses that we saw in February and March. It was the end of March when we saw that bottom. From trough to where we are now for the S&P 500, up over 40+%. So an amazing recovery. Usually what you'd see in these times, you'd see a reversal in treasury and safe haven assets. If you remember from that first quarter, you had equities and risky assets down significantly, long treasuries doing really well, bar cap ag the only other positive asset class. But you see, even those asset classes still eked out positive returns. We'll talk a little bit about our key market themes, but what's going on there is that the market, based on everything the Fed has said and done in buying bonds, is not expecting rates to rise at all. So those markets are even hanging in there, even as we've seen this tremendous risky asset recovery. Now, as we talk so positively about asset markets, we've also got to take a step back and compare that to the economic backdrop, which remains quite challenged. I won't go line by line through here, but you can see for the S&P 500, the earnings estimate, and I'll go a little bit deeper into this in a second, dropping 30% since the beginning of the year. And that's just an estimate. We haven't seen too many real results yet to start to extrapolate further. You can see the economic results. If you remember from a quarter ago, we talked about depressionary type statistics, even if we weren't going into a depression. And we certainly see that here with a quarter over quarter annualized number for real GDP growth estimated to be negative 33%. That's a consensus estimate from analysts. We see those final results in another week. And then we're starting to see the turning tide a little bit. You saw just today that new claims on unemployment were up for the first time since March after seeing a significant decline from some of those peaks. And so we're starting to see, as that fiscal stimulus fades, starting to see some troubling results from an economic perspective. The market doesn't seem to care though. The market has been on a tremendous run. And what we show here is the S&P 500 versus earnings. And you can see a close connection here over this relatively long 20-year time horizon. And that makes sense. Those fundamentals should matter over time. The market is probably going to be only so willing to pay for $1 of earnings. That's your price to earnings ratio. So you can have minor disconnects, but you expect those to come back in line over time. And we've zoomed in to make it clear here. You can see this tremendous disconnect. And this isn't even that full forecast for 2020. This is just the trailing 12 months of earnings. You can see this major correction and markets going the other way, just moving upwards. And we think that's largely why is the market just moving past this year? We think it's because of the stimulus that we've seen. Overnight, we saw the Fed balance sheet move from $4 trillion to $7 trillion. You can see so much of that is buying US treasuries, a lot of MBS as well, some other credit facilities, and then buying other assets like corporate bonds as well. We've seen that part before. We saw that in response to the 2008-2009 global financial crisis. What we didn't see as much that time around was the fiscal stimulus. And this is where we've seen a lot more stimulation than we saw before. This is mattering a lot to the economy. Now, we've seen an unprecedented amount in the US at 12+% with the CARES Act, and talk of more now. Amazing to see that across the world, in the developed world at least, the US is kind of middle of the pack. Europe has done a ton. You see that number from Germany compared to the amount they did in 2008, 33% of GDP. This doesn't even count the 750 billion that Europe just announced that they're willing to do. That was a big step for them. A question here is always, what did China do? Well, if you recall, China got through the challenges of COVID earlier. Certainly they haven't completely stomped it out. China announced a 4.5% fiscal stimulus package in May. So they're not making this chart actually. They haven't had to do as much, and you've seen some recovery in their GDP numbers. So if we turn to our key market themes, our themes are unchanged. Virus trajectory, how cases evolve for COVID-19, and how the economy evolves based on lockdowns or just general business sentiment, the general business environment slowing down a lot based on everyone's willingness to go out and spend, everyone's willingness to travel, all of those things. Permanent interventions, that's the stimulation theme for both the monetary and fiscal side, and an expectation that that will continue for quite some time. Then we have the many transitions taking place in China and the globalization backlash theme. We think those last two themes are meaningful and they will matter for quite some time, but the market can only handle so much at once. And right now, those are definitely on the back burner, and the ones that matter are the virus and stimulation. If we turn to the virus for a second, we think this will continue to move along a continuum, and we remain in that calibration between health risks and economic costs. I think what we're seeing in the US is a microcosm of what we've seen around the world, country by country, where there's a continuum region by region. When we talked last quarter, it was much more about the lockdowns in the Northeast on the coasts. Now we see, as those areas went through their lockdowns and have COVID more under control, we're seeing more challenges in the South, in places like Florida and Texas. And there's always the risk of the second wave that could move us further towards that health risk continuum than focusing much more on the economic costs. So this will be an interesting thing for markets to see how it evolves. And if more stimulation doesn't come along, that virus side could matter more. And if you remember, the first quarter was about the virus. The second quarter was much more about recognizing that stimulation. If it becomes much more about the virus or there's risks around the election, we could see some downside in markets. So that permanent interventions theme, we think, is just the driving force for markets right now. You see it displayed here for how much the Fed has done, how much the fiscal side has done. I mentioned there's potential for more stimulus in the US. There's conversations going in Washington right now. The consensus is that something will get done, maybe not on the order of the CARES Act, but something meaningful, something upwards of $1 trillion to further stimulate, further replace incomes, and get us through this challenging economic period. What does that mean for investors? We think it's not just the stimulus we see today, but the expectation that stimulus will continue, both from the monetary side in every way that they can, keeping rates low, buying bonds, and the fiscal side, putting money into consumers' hands so they can go out and use that to spend and move the economy along. What that means is that valuations can remain high, that with rates so low, the attractiveness of equities is more pronounced. Phil will talk about our latest assumptions, but you can see the differential here for the US at least, and this is true globally as well. The differential in return expectations for equities relative to bonds is so high that we do think investors will continue to seek those riskier assets. And even with all this uncertainty, we think tilting into risky assets does make some sense. Other actions that we see are to be very patient right now. There is so much uncertainty. I think it's hard to have really strong, high conviction views in this environment. And so diversification, having balance across risk exposures, and having the discipline of rebalancing remain so important right now. We talked about that need for risky asset exposure, not giving up on risky assets, even leaning into that a little bit. And then US and emerging markets seem to be more favorable right now than EAFE markets. We think slight tilts there make sense. If you've been holding that extra quarter of spending needs in cash, it may make sense to move that to a treasury allocation. If you don't have a treasury allocation already, we saw how important that safe haven exposure was in the first quarter. I think it might make sense to have a dedicated treasury allocation available when needed, to have that liquidity to put money back to work, to be able to rebalance into risky assets when times do become challenging. And so with that, I'll turn it to Phil to talk a little bit more about our strategic outlook.
Thanks, Tim. And I think one of the things that you'll hear from us, especially in our kind of strategic views, is a little bit kind of more of an emphasis of kind of back to core principles. And so as we look at the next page, and Tim mentioned this also, in a market with kind of pandemic and stimulus, it's so much harder for us to kind of develop kind of core conviction about kind of more tactical opportunities. Part of that is, it's difficult to kind of find kind of a true kind of valuation marker and kind of momentum marker. And frankly, the range of outcomes are so wide. So rather than worry about kind of outcomes over the next, several months or even longer, really focusing on kind of long-term objectives, and where do we want to be 5 years from now, 10 years from now. And I think, with some of the market dynamics that we've had over recent years, recent months, it brings about a couple kind of key items, which Tim also mentioned. One is the incredible stimulus from central banks and fiscal stimulus is really kind of, in our view, pushed interest rates down to kind of lows and likely to stay there for a long time. But it's also created a dynamic where it's likely pushed what we think are price to earning multiples and terminal values for kind of valuation metrics to be above what they've kind of ever been relative to history. So in many ways, to kind of distill it down to a simple statement, what price are investors willing to pay for kind of stable earnings or stable cash flow? And so with that comes, a bias to, thinking about, higher targets for equities, especially relative to what we're seeing in the fixed income space where, returns in fixed income are going to be low. And with that bias comes a kind of a favoritism towards both U.S. markets and emerging market equities. And we'll get into this a little bit, but looking at, targets of 60%, 15% respectively for those two entities. And then I think what is really kind of a core principle is encouraging everyone to have a dedicated strategic target to U.S. Treasuries. And I think, as we think about, the range of outcomes, whether it's a pandemic or kind of economic results, having that kind of source of liquidity and diversification is really kind of an important kind of point of emphasis that you'll hear from us for the rest of the year. So we look at the next page, won't spend a lot of time on this. And again, we publish our capital market assumptions on a quarterly basis. We certainly don't want folks to be running strategic asset allocation exercises every quarter. These are really meant for assumptions relative to your planning cycle. So if your fiscal year end ends in kind of 9/30, those are probably assumptions most likely to use. If you're on a calendar year, end of December, or if you prefer to do asset allocation work in the first quarter of the year, use those then. A couple high level points, which really rhyme with a lot of things that we've said, earlier. Not a lot of change here in terms of, our views on kind of interest rate sensitive asset classes. So you think treasuries, core bonds, tips. But really what you'll see is kind of how low they are over the next 10 years. So again, not really going to be relying on returns coming from kind of the fixed income space, but, a source of diversification and liquidity. And then we think about equities, the strong return we've had over this last quarter from the equity markets, certainly brought down our return assumptions. But one of the things is, depending on kind of what we view to kind of be the extent and the discipline to adhere to kind of a permanent intervention and kind of a market stimulus, really impacted kind of our kind of terminal value views for these markets. So the U.S. benefited the most in terms of a willing to let valuation sit at kind of high levels and even kind of above average levels. And you can see U.S. comes down the most relative to what we might see in EM or developed markets. So as we kind of walk through the next page, we'll talk a little bit about what we'd call our kind of strategic views. And we'll spend a lot of time on this before we hand it off to Sarah. But what we've kind of always had is kind of strategic views and strategic biases in various asset classes. So within the equity complex, thinking about kind of the three main levers you can pull from S&P, EFI, and EM. We're favoring, a bias to the U.S. into the EM. And you can see U.S. has outperformed over the last 10 years pretty substantively. EM has had its kind of day in the sun maybe 10 years ago. And we expect that to come back over the next 10 years. As our kind of overweight view for EM is really designed to, capture that higher return expectation that we're likely to see, specifically coming out of, Asia, which you think kind of the corpus of EM is really China, South Korea, Taiwan. And then when we think about US, there's certainly an elevated valuation that we can cite for those markets, but we think that might be one that could be a more secular trend to continue for a longer term period. And again, some of the dynamics that we're seeing in changes in the US equity markets lends itself to having kind of a slight overweight there. And so we think about, what are kind of weights for MSCI ACWI, which is a kind of our kind of beacon we look to. We encourage folks to have a US equity target of 60%, which actually is a fairly minor overweight when we think about MSCI ACWI has a US equity exposure of about 57%. And then on the emerging market side, encourage a 15% target relative to, roughly a 12% exposure for EM. And as we think about kind of other markets outside, just equities, I think a lot of clients have some level of emerging market debt exposure. I think one point is, think about your emerging market debt exposure within the context of a larger credit allocation. There's a strategic allocation to high yield, maybe bank loans. EMD is a part of that. So long term, we think there's a benefit to having high yield and emerging market debt, but depending on kind of where credit spreads are moving and how things are changing year to year, there may be more tactical levers you may want to pull in this space. But as we look at kind of the two main areas in emerging market debt, local currency and then hard currency, our view is fairly neutral between the two of them, and kind of longer term have similar return expectations for those two markets. And then last, we'll finish on kind of a core principle. As we talk about safe haven fixed income allocations, these are what we'd call kind of the core risk tools you'd want to use in a portfolio and kind of asset allocation concepts. As we label safe haven fixed income, the first thing we think of is treasuries. Provides the most liquidity, the best downside protection when equity markets falter or growth falters. But also we think about TIPS, and really having that TIPS allocation provides some inflation sensitive exposure should we see inflation move off kind of what are these historically low levels. So we'd encourage having a kind of balanced allocation between both treasuries and TIPS, and think that kind of over a long-term cycle provides kind of the best diversification for a portfolio. And it's not a chart we included here, but if you look at the 10-year and 20-year returns for core bonds, treasuries, TIPS in a blended treasury TIPS mix over a 10-year and 20-year time horizon, they're roughly all pretty much the same. And so in many ways, this is not a return statement. This is really what's the best available kind of diversification benefit you could find. And that's really what we're trying to emphasize here. And so with that, I'm going to turn over to Sarah to walk through kind of more of our kind of outlook and market views.
Great, thank you, Phil. Hi, everyone. So what I'm going to do today is now share some thoughts and insights from each of our 4 beta groups at NEPC. So that's equity, credit, real asset, and multi-asset. And this part of the presentation will focus on how to implement in your portfolio the asset allocation recommendations that Tim and Phil just described. So if we flip to the next slide and start with equities, and maybe even go to the next page because I'll speak to all of these points. What a difference 3 months makes. Last quarter, when we did this call in April, many equity markets were in bear market territory and liquidity was incredibly strained. Since that time, we've seen a tremendous recovery in risk assets, with nearly all equity markets posting double-digit returns during the second quarter. And that's great news for investors with equity portfolios, because we've benefited from those strong price gains, but we all feel and observe the growing disconnect between weak fundamentals and soaring equity prices. This is especially pronounced in US and growth equity markets. Value stocks have underperformed growth stocks by 23% year to date alone. Check out our blog on our website for more of our insights on value versus growth. As Tim mentioned, we are digging into this deeper. We've also seen large caps outperform small caps by about 10% year to date. And we're seeing a much narrower subset of stocks leading returns. For example, the FANG stocks represented nearly 50% of the outperformance of growth versus value so far this year. And as Phil mentioned, we recommend a slight overweight to US and emerging market equities, but we also recommend a balanced allocation to value and to growth equities. If we flip to the next page, when it comes to valuations, what we're seeing in the private equity markets is an entirely different story to what we're seeing in the public equity markets. With valuations, and this is the price at which deals are getting done during the second quarter, falling by 20% or 2 turns, from over 11.5 times enterprise value to EBITDA to just over 9 times. So private market investors are pricing in their concerns with the fundamentals of facing their portfolio companies. We're encouraging clients to maintain commitments to your high conviction GPs in private equity for several reasons. One is that capital committed during periods of economic distress or in the years immediately following economic distress has historically delivered the highest absolute return and the highest illiquidity premium, as starting valuations are relatively more attractive. And you can see that borne out in the bottom left chart on this page. Second, skipping vintage years means that you could risk losing access to funds permanently, and that is something that you want to be very careful about doing. If you do feel the need to reduce the dollars committed to private equity for any reason, or reduce your capital commitment budget, we recommend considering decreasing your equity check size, but maintaining exposure to all of your vintage years for high quality GPs. And then finally, we're really just advising clients to understand what you're buying. And that's true across the liquidity spectrum. We provide a number of metrics and tools, including those on this page, to provide a common language between private and public equities. So we can compare apples to apples, what's in each allocation, and build a suitable portfolio from a sector, size, leverage, and valuation perspective. For example, and this is not on this page, we observed based on our analysis that large buyouts on average provide exposure to portfolio companies that are smaller even than the Russell 2000 index. I think that's really important to understand, that buyouts are a great way to gain access to smaller companies, and it's an important part of the capital market ecosystem that you're not able to get in the public markets. If we flip to the next slide, we'll shift gears to credit. Again, what a difference a quarter makes. If we flip to the next page, credit spreads had widened dramatically and violently in March, as you can see on the top right chart here. There were 7 trading days in March that were the biggest daily spread moves in high yield ever. High yield started the year trading at 360 basis points over treasuries, close to the record tight. Spreads blew out to over 1,000 in March and have retraced to just under 650 basis points back to pre-COVID levels. And this is in large part due to the significant accommodative monetary policy employed by the Fed and fiscal policy. We've also seen a huge number of new issuances and retail inflow into the credit markets, which has helped to improve liquidity even further. That said, the Fed cannot cure fundamental issues related to COVID, such as declines in corporate profitability margins, deterioration in credit quality, and sector-specific weakness. There were causes for concern that were being priced into the high yield market even before COVID, with leverage ratios rising and interest coverage ratios falling. The high yield distress ratio continues to rise and stands at nearly 30%. That's a measure of the percentage of bonds that are trading over 1,000 basis points. And bank loan defaults continue to rise. When we think about credit opportunities and opportunities to invest in credit in the wake of COVID, the short-term immediate investments have passed, like TALF. That was a very short-term investment opportunity. That said, in the medium and longer term, we do expect to see more distressed and dislocation opportunities in high yield bonds, bank loans, and structured credit. So while a distressed opportunity may be in our future, we don't know when it will be. There are a variety of levers that exist to capitalize on this, but it's important to understand the trade-offs between liquidity, return, and risk. And we're really advising clients to continue to be prudent when you're investing in credit. Understand the risks before going out further on the risk spectrum. We flip to the next section, 1 page forward, we'll talk about real assets. If we flip to the next page, we've got some charts that graphically show what's happened. Real assets like real estate, energy, infrastructure struggled in the wake of COVID, with public real asset equity prices declining and rebounding the most, as we'd expect for a very liquid equity investment. Private market real asset valuations like private equity are still flowing through and adjusting to the current environment. This is not unusual for there to be a significant lag in pricing. Price discovery is just difficult in many sectors with limited transaction volumes. Deals just aren't getting done. But if we look from a sector's perspective, on the real estate side, there are some sectors within this area that are actually holding their own or even benefiting from the COVID economic environment, like data centers, which you can see on the top here have outperformed, healthcare, and industrials. If we flip forward to the next page, another big theme is the decline in oil, which has hurt transportation infrastructure and energy assets. Energy experienced in March and April a double shock to both supply and demand. We saw oil prices fall over 60% during that time period to $27 a barrel. And while prices have recovered into the $40 a barrel range, they're still down 35% year to date. When it comes to real assets investing, we're advising clients to remain patient in deploying capital into real assets. Opportunities will surface, but it may take some time. Look for managers that have experience navigating distressed markets. They should be able to deploy capital into the next several quarters, and it's really important for them to have experience doing that in prior cycles. Similar to private equity, we're advising clients to stick to your commitment pacing plans, especially to your high quality and highest conviction GPs. And finally, we suggest that you pay extra attention to asset quality. This is going to be a really important feature during the next market sell-off. I'll round out today's presentation with multi-asset. This market environment, as difficult as it has been, offers a good opportunity for us to take a step back and in a calm way revisit the goals and objectives that your multi-asset portfolio had going into this. And really to ensure that your multi-asset portfolios are performing in line with your expectations. So what was the goal of each multi-asset allocation that you have? Was it diversification? Was it market exposure? Was it to provide downside protection? And then once you've determined what those goals were, take a look at performance and behavior of those strategies. In this sell-off, did the strategies perform within your expectations? If they didn't, it might be a good time to think about strategic allocations changes within the multi-asset portfolio. If these strategies did perform in line with expectations, but it caused significant amount of stress for you or your investment committee, that's another data point that's important to consider, especially as it relates to risk tolerance. Finally, if you need liquidity and are looking for sources of liquidity, there are certain multi-asset portfolios that could be good sources of liquidity if they've performed well during this recent sell-off, for example, GAA and risk parity. So with that, I will turn it back over to Tim.
Great, thank you, Sarah. We do have several questions, so we'll go around with those. If you still have a question and haven't gone to that chat box, please feel free to do so. We'll try to get to as many as we can. We'll start with one. We had several questions on inflation. I think I'll take this one. Summarize as saying, do you think there's risk of higher inflation? I think that was the tone of each of the questions that we got there. And I first say thanks for that question, because we didn't really hit on inflation. I think it's important to discuss. And I think I'd come back to a key point that we've made throughout, that uncertainty is incredibly high right now, and the range of outcomes is really, really wide. We look back on the last financial crisis, and I think many market commentators, NEPC included, thought all of the stimulation that was coming into markets through quantitative easing, all of that liquidity hitting the system would lead to inflation. It did bring on inflation. It just wasn't consumer price inflation the way we classically think of inflation. It was asset price inflation. It stayed within capital markets. All of that stimulation was monetary in nature. Now you think about the stimulus that's happening now, it's much more, and likely to be much more, on the fiscal side, with monetary policy essentially tapped out, rates already at zero, and the Fed making it very clear they're not interested in moving into negative rate territory, seeing some of the downsides that would come with just the incremental benefit of stimulating a little bit. Right now, that fiscal stimulus has just replaced lost income, so it's not leading to higher velocity of money. To the extent that that fiscal stimulus goes, quote unquote, too far and does more than just replace income, to the extent that it's above and beyond, and you have more money chasing a fixed number of goods, we could see more inflation. And so we think right now the market is not pricing in much inflation at all. The break evens are quite low, but we see risk of higher inflation. We certainly think that probability has increased, but we do think it's a way off given the current economic conditions. We look for more from us there, from the real assets perspective and from a portfolio implementation perspective. We do think many portfolios are under allocated to inflation hedging assets. We think we have a good amount of time to build that exposure to get to the levels that are probably needed to protect a portfolio. I'll turn to Phil for a question, and it's on our equity implementation recommendations of overweight US and EM. How do we reconcile that view with some of the COVID dynamics that we see right now, where Europe has actually, despite some really tough early challenges with COVID, seems to have COVID more under control, and the US might be more at risk of a second wave?
Yeah, thanks, Tim. I think this is a really difficult question, and part of that, kind of, we highlighted is why it's I think so challenging to develop kind of a shorter term view on things. Is conditions on the ground are changing week from week. Whether within the U.S. and frankly within different parts of Europe. So I think in some ways we know that COVID broadly as a pandemic is driving market pricing, but there's also an aspect that central bank activity is also driving market pricing. And I think the extent, especially in kind of the near term, I think we have great conviction that the Fed in many ways will do whatever it takes. They've expressed that, they've demonstrated that now, and there's less of a kind of belief in that, frankly, from Europe, despite the recent kind of really strong things that they've done. But I think what's more important, rather than what's going to happen over the next 3 months in terms of transmission rates or kind of virus prevalence, is when we look 5 years out, where are corporate earnings going to be? Are they going to be relatively unchanged? Are they going to be higher, lower, disrupted from the pandemic? And I think that's the piece that we're more focused on. And so as we look at kind of 5 years out, the dynamics that exist in the U.S. with kind of a very unique tech sector, and kind of higher margin businesses, lower CapEx requirements, greater return on equity, and frankly, more stable cash flow companies, that gives us a bias longer term that we have more confidence in the U.S. being able to meet kind of earnings numbers over a kind of a longer term horizon relative to, let's say Europe. And I think that's really the emphasis on a strategic view, is not what's going to happen this year, but more of how does this change your view of markets 5+ years from now? And I think that's what we're really trying to emphasize here. And so with that comes a bias towards the U.S. And then also with EM, and within EM, many of the dynamics within Asia are somewhat similar to the U.S. in terms of growing consumer and tech trends, that we also kind of prefer Asia being the more dominant risk source, let's say, in kind of emerging market equity exposure.
Phil, you mentioned the Asia being the dominant risk source. A follow-up question while you were kicking this off about maybe overweighting Asia. Do you think there's just enough exposure to Asia in the EM index already, or maybe you want to comment on the potential long-term for some dedicated China exposure?
Yeah, and I think there's two pieces here in terms of how we view it from kind of a structural standpoint. Is yes, we'd like to have an overweight to EM, but there's also thousands of companies that operate in the emerging market universe, and what we want is to have kind of high conviction equity strategies that are actively picking those stocks and those companies and generating alpha for your portfolios. And I think when we look at where we think the most favorable kind of economic trends are, definitely we think are coming from Asia. And in many ways, China is the kind of dominant risk source in terms of setting kind of market sentiment for Asia and most of EM. And so then kind of the ability to kind of build up kind of exposure directly to China, whether that might be in private markets or other areas, we think is one lever to pull to get some more exposure.
Great, thanks, Phil. And Sarah, I'll turn to you for a final question here. Also, I think with an element of Asia to it, it's more about private markets implementation, how we evaluate emerging market private investment opportunities versus those in the U.S. Maybe you want to talk about some of the work we've done in China on the private side.
Yes, absolutely. So at the end of the day, we are using our same investment process and our same hurdles and investment criteria to be able to invest in an emerging markets, private markets fund versus the US. So using the same approach, but with some tweaks. Before I go into those, as Tim mentioned, we have a pretty robust team that we've put together in a robust effort to really get to know the China marketplace, get to know the best investment opportunities there. We took 3 trips last year. This year, our trips had to be paused for obvious reasons, but it's a really important part of our underwriting and our diligence. Some of the things that we spend extra time looking at in emerging markets is how developed is the ecosystem. And what I mean by that is how viable are exits? Are there going to be buyers there? Is there a route to IPO, or is there a deep market of strategic corporates to take over the investments when it's time to sell? Another important thing to do is to look at the track record and understand how much of it is unrealized versus realized. One of the things that we've seen in certain countries is that the unrealized track record looks great, but there actually haven't been too many exits that they've brought to fruition. We look at public market equivalents versus the relevant index. And we really just are understanding the different types of exposures that we're getting. China's a great example. China venture capital has a very different approach to US venture capital. China VCs are going to focus on consumer technology companies, whereas US VCs are going to focus on enterprise tech. So you are getting different exposures there. And that's sort of what I was alluding to earlier, which is understanding what you're buying and how to build a portfolio holistically that gets you lots of different exposures to the capital markets.
Awesome. Thanks, Sarah. Thank you, both Sarah and Phil, for your insightful comments. Thank you, everyone, for joining us today. I hope this was helpful. I think the big things that you heard from us were we see pretty challenging economic conditions right now as the U.S. economy, the global economy works its way through the uncertainty and challenges of COVID-19. But we see an ability to provide support to the economies from governments, and we think that will support financial markets. If that seems like a hedge or kind of a mixed message, I think it's intentional, and it reflects the amount of uncertainty that we see right now. Some of that stimulus could overshoot, as we mentioned in the Q&A, and we could see inflation. That stimulus may not be enough, and we could see a major economic downturn and a major market downturn as the market resets what the government can actually do. The uncertainty around COVID, with all we're still learning about COVID, the potential for a vaccine, just means there's so many outcomes possible and such a wide range. And with that, while we have some views within asset classes about overweighting regions or building a treasury allocation, I think that big message overall is to stay diversified and balanced, continue rebalancing when you have those opportunities. I think that's how you have success. Having that discipline over the long term is how you meet those long-term objectives. So thanks again for joining us today. Hope this was helpful. I hope everyone is safe and healthy, especially those in some of the most affected regions by COVID-19 right now. If we can be of help in any way, please let us know, and we look forward to chatting with you once again. Take care, everyone.